Well, welcome to our monthly strategy update. I can't believe that it's September already, and that only means Halloween, Thanksgiving, and Christmas, and we'll be at the year end before we know it. My name is Keith Durand. I'm the Senior Vice President of Business Development for Lear Investment Management. I'm joined by the Director of Research and Co-Portfolio Manager, Jim Warner. On behalf of everyone at the company, we'd like to thank you for taking this time to join us. As you know, these calls are designed to not only give a glimpse into the macroeconomic data that we're analyzing, but it in turn, how that affects our tactical positioning and, of course, the securities that we own. So before I turn it over to Jim, we welcome your questions. So please use the Q&A button that is at the bottom of the screen. Feel free to ask as many questions as you like, and then we will address those questions at the end of Jim's prepared comments. And so with that, I will turn it over to you, Jim.
All right, great. Thank you. Appreciate that, Keith. Thank you to all of you who have attended today. I'm going to go ahead and share my screen as I normally do, and we'll get right into it. Okay, so the title of this month's webinar is Better Economic Data plus Fed Pivot equals Market Rally. And that's really what we've been experiencing over the course of the last several weeks after the big pullback that we had in predominantly July. For those of you who attended last month, we went through essentially why the pullback happened. And we really basically divided it into sort of two phases. One, which is kind of more technical, is this pullback in AI stocks. And obviously, if you've seen a chart on NVIDIA, there's been a pretty material pullback in that stock. A lot of that was just basically being sort of overbought. And there was just nobody left to buy NVIDIA stock, and it didn't take much of a rumor around a delay in Blackwell chips to really roll over that stock and really the whole associated set of peers. But then there was a second phase, and that really happened when it sort of called into question the fundamentals. We got a weak payroll employment number in the ISM manufacturing towards the end of July, and then we got a very bad payroll print. And I'll go into this a little bit further, but essentially what happened was the market all of a sudden shifted its mindset to giving a higher probability that we go into a recession as opposed to a soft landing. And so when that happened, we sort of got this pullback, this second pullback. And with that, we had also the blow up in the yen carry trade. And that actually kind of raised our eyebrows more than even the other drivers of the pullback. Because what happens is when you have these big blow ups in big crowded trades like the yen carry trade, there can be contagion. And so we waited a few days to do anything to take advantage of the dip in the market in order for things to kind of settle out. Because oftentimes what happens is that one market can get very unsettled. And if you have margin calls, large hedge funds often have to sell whatever is available. And so even though it's an uncorrelated asset, you could still see pullbacks in other corners of the market, like large cap stocks, for example, that are very liquid to help make up for those margin loans. So that was sort of the big risk when we last spoke. And then that essentially cleared up and we got this nice little rally. Now, what's really interesting to see in the last couple of days, the AI stock rally has really kind of petered out. These charts are just a couple days old, but we're still basically at a place where the S&P and the NASDAQ are up high teens for the year, which is a great year. But what's really caught up recently has been the S&P equal weight, which obviously reduces the influence of the Magnificent Seven. And we've also seen the Dow break out to new highs. Now, these indices have lagged, of course, because they don't have AI really in it to drive it, as does the NASDAQ and the S&P. But you can see that other than the AI stocks, stocks are actually working out okay. And so this is a good sign for balanced portfolios, that there's places to be other than just AI. So what's become increasingly important is the actual economic data. With the concerns raised by the payroll report, last month's payroll report, the market has really become hyper-focused on each additional print. And thankfully, thankfully, these subsequent prints, so the CPI, the retail sales I've listed here, unemployment claims, personal income, spending, core PCE, all of these important numbers came basically in line or a little bit better than expected. And that really helped support this rally. It basically said, okay, I know that was a worrisome payroll number, but the economy isn't really rolling over and going into the tank just yet. And so we continue to be very reliant on data going forward, and I'll show you some of the data points we're watching very closely. But this was a good sign, and this is what was supportive to the market last month. The other very supportive thing happened on the 23rd was the Fed Chair Powell's speech at the Jackson Hole Symposium. They hold this every single year, and sometimes it's newsworthy. I would say this year was particularly newsworthy for basically these two comments. The first comment was basically, he said that the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and balance of risk. And I think what this comment did was provide some assurance to the market that the Fed is very aware that it is time to start cutting rates. Obviously, we don't know anything about the pace and timing exactly, but it's certainly put in everyone's mind that this September 18th meeting is likely to produce a rate cut. And I think that pivot towards a rate cutting cycle is very, I think, important for market sentiment, but also for the economy. And we'll get into that in a second. The second statement that I thought was very important in that speech, that really implied that the market was focused on the labor market and was willing to act swiftly if they saw weakness in it, was the following. He said, quote, "We will do everything we can to support a strong labor market as we make further progress toward price stability. The current level of our policy rate gives us ample room to respond to any risk we may face, including the risk of unwelcome further weakening in labor market conditions." So right there, you can basically take a great deal of assurance, I think, that the Fed is focused, although we've yet to see any action yet, but they are very focused on the right thing, which is the labor market. And taken together, it looks like we're going to see a rate cut and the beginning of a rate cut cycle. So I think that's very important for both market sentiment and holding up the economy in the future. I've shown this graph to you now several months in a row, and it's basically our interpretation of how tight monetary policy is. It basically looks at the Fed funds effective rate and subtracts out core PCE, which is just inflation. And what you can see is that when it's gotten this, the spread between the two has gotten this wide, and ergo monetary policy has gotten very, very tight. We've generally had a problem in the past, and the first time we saw this was at the dot-com boom, and we all know what happened after that, and then right before the great financial crisis. Now, I am not using this as to point out that we might have a crisis on our hands, but I am using it at least to signal that I think that the time for cutting rates is now, and it needs to be substantial. This is effectively a visual picture of what the greatest fear is that the Fed will keep rates too high for too long, and ultimately the economy falls into recession. But these comments from Powell, I think, are certainly give us some assurances that they understand this. They've seen some version of this graph and understand the importance of making sure that they start easing policy. So, of course, the market is very quick to assume rate cuts. As of just a day or two ago, it's roughly about the same today. You can see from the Fed funds futures graph here, what I've done is I've pulled out the implied yields for each of the next, Fed meetings throughout the next 12 months. And so you can see that the Fed is basically assuming right now that the Fed will cut all the way down to about 3.25% a year from now. Now, the general theory is that a neutral monetary stance is with interest rates around 3%. plus or minus some standard error. And so so the market is essentially assuming that the Fed will take us from very restrictive 5.25, 5.5 down to, closer around to that neutral rate over the course of the next year. That's what the market thinks. Now, as we all know, having looked at this Fed Fund futures graph in the past, we can almost guarantee from that experience that this is not how it's actually going to play out in reality. But at least it's instructive to see what is priced into the market. So all in all, what the market is saying is we think there's going to be about 9 rate cuts over the next 12 months. Now, this week, the single most important data point is payrolls, and that's this Friday. And right now, the street is expecting the economy to have added 160,000 new jobs, net new jobs, to the economy over the month of August, which would be up from the 114,000 last month. And remember, that was a very disappointing number. I think if we get a number that's at 160 or better, you're going to see the market rally off of that. If it's worse and we get another bad print, we could have another significant rise in concerns that the economy is going into recession, and so you might get a further sell-off. Time will tell. But the other important data point from this report will be what happens to the July number. So every month, when they publish the new number, in this case it would be August, they go back and they revise the July number or the prior month's number. I went through a chart last month and I showed you that almost every month this year, the revision has been negative to the tune of 20%. So if we were to see something like 114 get revised down to 100,000, that would actually be pretty concerning. And so we're going to have to look at both the August print and the July revision to really kind of figure out whether this market rally can sustain itself or whether there will be growing fears of recession. What worries us about the labor market when we look at it has been, and I showed a chart last month about the unemployment rate. And what's essentially happened is since last year, the unemployment rate has basically gone from 3.5 to 4.3%. And there's been an acceleration in the pace, in the increase in the unemployment rate over the course of the last 3 months, which is directionally a little concerning. Now, what's driving that is really interesting. We went back and we looked at it, and it's not actually the number of employed persons, but it's actually the labor supply that is actually growing faster than employed persons is. And so if you look at this chart on the bottom left, the civilian labor force, so that's the labor supply that I'm talking about, is this black line. And you can see this sort of accelerating little increase in the last couple of months, whereas below, the lighter blue line is the number of employed persons in the U.S. And you can see there's sort of more of a flatter trajectory up. If I subtract the bottom from the top, I get this chart on the right. And so you can actually more easily see that this acceleration or this increase in labor force relative to employed persons. So we're going to have to watch that. Now, a lot of that is being attributed to migrants that have recently come into this country. So this is something that's kind of interesting. We're going to have to keep watching it. The other data point that came out over the course of last month is that the BLS every year goes back and they kind of look at their models and they do another big revision. So they do a revision every month, but then they do one big annual revision. And what they basically found was that the number of employed persons was actually 818,000 fewer through this analysis. So while, again, we're talking about statistics, and so that's only about 0.5% difference from the actual reported number. That could be within the standard error of the survey, and so really doesn't mean much. But it also could mean that there honestly are almost 1 million fewer employed folks, and so we just don't exactly know how that is going to get allocated out across months and whatnot. We don't get the final revision until February, so stay tuned for that. But it certainly does feel like it's a weaker number, and means that the labor market is maybe not as strong as it maybe otherwise we've been told. So how does this impact portfolio strategy? Well, first, let me address, go back to the beginning of last month where we had all that volatility. That Monday, August 5th, was a pretty scary day. And we were worried that something was going to break. The VIX, which is the chart on the right, obviously it's a measure of the S&P 500's volatility, spiked up north of 60. I mean, it spiked to levels that we haven't seen since the onset of the pandemic. So it was a pretty scary number to see that. And we think a lot of that had to do with the yen carry trade unwinding. But as I said earlier, that kind of a spike can break investment models and can force investors like hedge funds that are in that trade and are very levered to have to unwind other types of trades. And so what we did basically, if you recall in our last call, we basically said we are just sort of, we raised some cash and we were just sort of sitting, waiting to make sure that, that something didn't break. And that's essentially what we did. So we waited a few days to start adding back risk to portfolios. And so along about the 8th, and then again on the 12th, we started adding back to portfolios, but we did it in a very careful way. As you can tell, there are, I think, more question marks today about the direction of the economy than there was a few months ago. And so this isn't just a go risk on type trade. So what we did was we divided out how we were applying that extra risk. We added to our fixed income exposure. And importantly, as you know, we've been very open about moving out the curve as a way to hedge risk in the portfolio. And then we also started nibbling on some of the AI stocks that have really gotten hit very hard. We added a little bit to a new stock called Micron. Micron is an AI memory chip manufacturer. And this one had pulled back even more than NVIDIA, it pulled back over 40% from its highs. And so, when you step back, when you step back and you look at what's going on in AI, a lot of this is just technical. We know there's a ton of demand for AI. There's a ton of demand for chips that NVIDIA makes. Ultimately, there's going to be a ton of demand at the smartphone level. We know that AI is coming out in the new iPhone. You need memory chips for that. We know that there's a huge tailwind to earnings. But what's important is that a lot of that had gotten priced in. And so this pullback isn't necessarily, a sign that the fundamentals are weaker. It's just that the valuations had gotten out of control. And so there's a lot of opportunity to take advantage of this pullback. But we need to do it in a very rational and slow manner. We also added a uranium miner, Chemco, and a few days later. Now, what this was sort of, we had sold our uranium exposure earlier in the month to take down some risk in the portfolio. Now we're basically adding it back, but just in a slightly different manner. So, the point is that we're not in a strong risk on market. We do want to take advantage of dips. We want to make sure that there's that the fundamentals are obviously solid. And so we are allocating out those dollars in sort of a careful risk adjusted manner. So the potential paths forward, really are two. There's sort of the base case that I think the market has embraced, which is a soft landing. The labor market holds in, consumer spending remains, strong. The Fed can gradually cut rates. There's no emergency cuts. That actually should create a pretty healthy environment for stocks and bonds. And we think we're probably still in this environment. By the way, the labor report is a very big one. The payroll report of this Friday is a very big one to determine whether we're still in this category. The alternative is that we go into recession. So the labor market deteriorates further. That's going to obviously impact consumer spending. That's going to slow down the economy. The Fed would be worsened if the Fed didn't cut more aggressively. But we have to sort of take Powell at his word at this point that they are at least paying attention to this. And so if they see a dramatic weakening in the labor market, we could see faster rate cuts. I think that's going to lead to, though, a fairly volatile market situation. Stocks will likely decline. Earnings will have to reset lower, but high quality bonds will fare pretty well. So, I keep coming back to the point that fixed income is actually a great place to hide. It's a great place to where you can get some yield finally after decades of no yield, and also insure against any of the equity volatility in the portfolio. So there's some really key market catalysts that we're focused on. Actually, two of them have just happened. So yesterday we got the ISM manufacturing, which was pretty bad on a bunch of different levels, and that's why you had a big market sell-off. Today, though, we got a JOLTS, the job openings index, and that actually was lower than expected. Now that's a bad sign for the labor market. However, it probably means that the Fed's going to have to cut more. We'll have to wait and see. Tomorrow we get ISM services, and then Friday, of course, the non-farm payrolls. And then in the middle of the month, we'll have retail sales. And then finally, we'll get on the 18th, the Fed's rate decision. And right now, the market is looking for either 25 to 50 basis points. And I think depending on how this data pans out, how these other data points pan out, if they come in weaker, like this JOLTS report, like the ISM has, we see, the rest of these data points weaker. I think it's more likely we'll get the 50 bips cut. Otherwise, if they kind of come in generally in line from here, like they did last month, I think we're looking at more of like 25 basis point. Either way, I'm not sure that it actually matters a whole lot which way it goes. Really, what's going to matter is just how aggressively, how weak is the economy, and how aggressive does the Fed have to be to lower interest rates to keep things going. So, we're at a very interesting point in this market. So some of the other portfolio actions that we've taken and are considering. So buy the dip in AI. I mentioned earlier that we bought some Micron. For people who've listened to this in prior months, we bought Oracle and some other names. And the point here is that we still own NVIDIA. We're underweight, but we own it. But I think where the market is moving is it's moving towards other AI winners that maybe haven't seen the big tailwind to fundamentals that NVIDIA has had, but they're next. They're next in line to see their revenues take off. And so we're really more focused on moving out to look beyond NVIDIA to the other, future winners of AI. We still love commodities. Our gold play has been a terrific hedge. It's actually worked very, very well over the course of the last year. And then we added back uranium. We think that there is a structural supply deficit relative to demand that is probably decades long, and we're just at the beginning of that trend. So that's important. Copper miners are also interesting, particularly after the blow up in the AI stocks. A lot of copper has been tied to AI because you need so much of it to build these data centers. And so it's been quite weak over the course of the last month or so, but we think that there's a great opportunity over the long term there. I mentioned it before, but we're buying fixed income. We're moving out the curve in duration. We think it's a great hedge in case the economy worsens. If we fall into that recession scenario, these bonds will do great. And you're getting great yields, best yields we've seen in decades. And then there's always opportunities to buy overlooked value. Whenever you get these shakeouts and this volatility, there's very often times the proverbial baby getting thrown out with the bathwater type situation where excellent companies are just misunderstood, and investors get the itchy trigger finger and just leave. And so we're looking around at a number of different opportunities like that. And so all of this means is that we think that having a balanced portfolio and balancing the equity risk, taking smart risk, if you will, with fixed income and commodities is the right approach. So the key considerations going forward, these are the things that we're thinking about on a daily basis and discussing. AI is real, but everybody knows it. And so we have to be very careful to avoid crowded stocks, crowded positions. And what crowdedness simply means is that everybody's piled into it. And so when everybody, it's like, think of a boat, when everybody goes to one side and the boat leans like out of whack, it doesn't take much for the boat to go back to the other side. So we're trying to avoid crowded trades. And as you saw in those earlier graphs about the S&P 500 equal weighted index and the Dow, the non-AI stocks, are they going to play catch up? Are they finally going to have their day in the sun? Some of that has to do with making sure that, with the economy and if it hangs in there. But there's a lot of great value outside of AI that shouldn't be overlooked. And then bonds, I mentioned, great hiding place. We're consistently looking for more opportunities to add fixed income to portfolios. And then taking a slightly different tack here, we're spending a lot of time trying to think about what a Harris administration would look like. Obviously this election appears to be a total jump ball. We have a general idea of what, pretty good sense of what a Trump administration would look like. But we really don't have a full picture of what a Harris administration would look like. Of course, all of this would be speculation anyway, because we don't know how the Congress is going to shake out. So it could very well be that we have split houses and nothing gets done. But the one thing that we do know has to get done is something on the tax front with the Trump tax cuts sunsetting, a lot of them sunsetting next year. That's going to be the big order of business. And it could have material impacts, good and bad, on the market. So we're going to be highly focused on that as we move into 2025. Obviously, there's going to be a lot of discussion around how aggressive the Fed will be in cutting rates. I have a feeling they're going to hope for kind of just a steady, slow progression. I think if they have to get really aggressive, it means that the economy is really rolled over. And don't forget, there's a lag effect. So, just because, if you see some weakness today, if you drop rates 50 bips, that doesn't, just immediately accelerate the economy. It takes time to work through. So there's a real timing issue here in terms of the lag effects of dropping rates and how it's going to play out in the economy. And then finally is the consumer cracking. So Dollar General, and the Dollar General and one of its peers actually recently come out and said that the lower income consumer is really pulling back. Now, does this move into the middle class or middle income folks? Who knows? But we're listening very closely to retailers in particular to see what they're seeing in their customer bases. So that could be a very important data point to follow going forward. So let me finish on a positive note, and then I'd love to take your questions. I used this slide, I think, the last couple of months because it really, really is remarkable how much money is sitting in money markets. The current total is $6.3 trillion. That's almost double what we previously experienced pre-pandemic. So there's just a lot of folks that are sitting in money markets, and they're earning great yields of 5.25%. We have plenty of clients that prefer to be there now. But at some point, they're going to have to move out of the money market. Why? Because the Fed is going to start cutting rates. So if you think back to that Fed futures slide, 1 year from now, the market thinks that interest rates will be 3.2%. Well, that's 2 full percentage points lower than where you are today. And so some folks in money markets at that point will say, well, gosh, I still like getting that 5% yield, but you're going to have to take more risk to get it. You're going to have to go buy bonds that are further out the curve, or you might even have to buy stocks. And so I see this as almost a tsunami wave of cash that could come into the market, which is great because it means that if we have big dips, there will be dip buyers, we believe. And of course, time will tell. And let me stop there and take questions.
So we do have a couple of questions. Just before we get to them, though, I do have a question. So whether the Fed cuts 25 or 50 basis points, it doesn't really change what we would do or might do in the portfolio?
Not really. It's, it's pretty immaterial, the actual amount relative to, the upper bound right now, which is 5.5%. It really doesn't move the needle. I think it's just more from a psychological standpoint. If we get this situation where, the payroll numbers come out fine and some of these other economic data points are fine, and you get some, lower interest rates, that's a much more bullish environment than if you see the economy, the economic data rolling over and the Fed has to get really aggressive at cutting rates. Like that's a bad scenario. And we just honestly don't know where we are right now because we've had some, weakening data points in general, but nothing that is really, obviously the payroll number last month raised some eyebrows. Yesterday's ISM manufacturing raised some eyebrows. So, don't forget, a lot of investors are up this year. Most investors are up. So there is a natural desire to, bank your profits and wait for a lot of this volatility to pass.
Right. Right. So the first question has to do around gold, and of course we've been, big believers in gold for a long time. But the question is simple: is just, do you believe that gold is overbought?
I mean, it's not really. I mean, I think that gold has maybe at the beginning of a long cycle upward. Um, it's technically at a point where it could actually break out. I would say after the recent pullback, the gold miners are definitely not overbought. And in fact, if it weren't already a pretty sizable part of our portfolio, we would be probably buying more.
Wow. Okie doke. And then are you concerned that personal debt is growing rapidly? There's all this, a lot of news that's been focused around, the consumer having to use credit card to pay for food. And so anything you can
Yeah.
mention?
Well, the average consumer's balance sheet's actually never been better. And a lot of that has to do with the fact that a lot of folks have tons of home equity and that goes to their wealth. So yes, it's an accurate statement that credit card balances are starting to really increase. Now, interestingly, though, we haven't seen delinquencies really climb that high yet. I mean, they're still in the process of normalizing to pre-pandemic levels. And so, we are watching that scenario pretty closely, but right now it doesn't look like it's going to be a big deal. Now, any credit card company will tell you that the way to predict charge-offs is the unemployment rate. So if the labor market does roll over and you do start to see people lose their jobs, that you will see credit card delinquencies increase. You will see mortgage delinquencies increase. That is just how it works.
Yeah.
We, you know, we have basically avoided as much as we possibly can having any exposure to credit, to essentially, particularly consumer credit. Um, it just felt like a little too good, and that there was only one direction, and that was to get worse. Now it's normalizing and getting worse and kind of going back to historical levels, or it's like really getting bad. And so for that reason, we've just avoided that as much as possible.
Right. And then one last question is: do you finally see that the market is broadening like we had hoped for?
Yeah, that's a really interesting point. I mean, I think the answer is yes, but I don't know how long how sustainable it is. So when we talk about market broadening, the easiest way to think about it is you have the Magnificent Seven, right? Among them is Nvidia, and those have been basically leading the market now for a year and a half, predominantly. And you can also look at this as growth versus value. Growth has been outperforming value, for the last year and a half or so. Will there be a point at which value starts to take over? I think the answer is, right now we're getting a lot of choppiness, right? There's this technical pullback going on that certainly in the short run is value outperforming growth. And so you're by definition seeing the market broaden. That's what we mean by that. But on the other hand, like if we get into a recession, one could argue that the safest place to be is in technology and in these growth names because they have these giant secular tailwinds growing their earnings. And if they've already corrected like they have, then you actually might see growth outperform value in some strange, ironic way. And so, I think what you have to do as a portfolio manager is essentially you have to dip your toe in both buckets. And so we have a little bit of value and a little bit of growth in the portfolio. We've got a little bit of exposure to the Magnificent Seven, and it's balanced out with some other. This to me does not feel like a market where you can just kind of go all in on one factor. This is really kind of a market where you need to be balanced.
Gotcha. Okay, so it looks like that's all the questions that we have for this session. With that, just to let everybody know that we will make the video available once it's been through compliance. And we again would like to thank you for taking time out of your day to spend these 36 minutes with us on the call. And we look forward to seeing you next month. Bye,
Thank
everybody.
you. Take care.